Welcome to the State of the Nation Business, brought to us by Corion Capital. Go and consider, go to their website. If you want to see a good asset management company that will look after your investment, Corion Capital, definitely the place to go and look. And we know they're good because we get them here every couple of weeks or so, and we get to discuss the performance of the market. And these are people that are in touch, they are serious players. And joining us today from Corion Capital is their CEO, Gareth Montana. Gareth, welcome to your debut performance on State of the Nation Business.
Thanks for having me, Mike.
Yeah, and this is done. We do this in conjunction with you guys at Corion Capital, and let's look back at the performance of the market as we head towards the end of the year. It's been quite a time, quite a good month for South African markets. What is driving this performance in the South African markets?
Yes, I think first of all, another good month, but just a continuation of a protracted period of really good performance. And, once again, resources, the stellar outperformer. We've continuing to see, firm gold price, firm platinum price, and it's been a great underpin. And, once obviously South Africa is blessed with resources, it's one of the stalwarts of the backbone of our economy. And although we've been through the doldrums for a period of time with commodity prices, as buoyant as they are, it's a strong positive for our markets.
Yeah, and it seems very much, if one looks at the medium-term budget statement, which we're going to go into, parts of that, it feels like there's a bottoming of the economy. Some of the fiscal picture is looking a lot better, and that's now sort of playing through into the market evaluations, isn't it?
100%. There's actually many elements. If you look at where South Africa is sitting right now, I think as South Africans, we are resilient, but we can also be pessimistic at the best of times. But if you're starting to see some green shoots, you're starting to see some tailwinds that, should we get a few things right economically, politically, there are lots of positives. So first of all, we've got the commodity prices, which are underpinning. We've had, one of the best performing state-run entities in South Africa is SARS, revenue looking really strong from a SARS perspective. We've had an upgrade for the first time from a rating agency. We've had a rate cut. So there's lots of positives to lean on, and, couple that with the strong market performance. Sentiment's contagious. If we start getting a lot of positivity coming through, it's contagious, but it's also self-perpetuating. People start getting confident. They start investing. Businesses start investing. Maybe new mines start opening up. And these are the things that we need to start getting going and address some of our key issues: unemployment, disposable income. But it all it lends itself to a self-perpetuating cycle.
Yeah, and now, Gareth, of course, it lends itself to that burning question, which we're almost too scared to ask, is dare we allow ourselves to get bullish about South Africa and South African markets?
So the short answer is yes. And from a Corion perspective, we've been bullish about South African markets and assets for a while. So not just equity, South African bonds. And potentially we're a bit too early on the equity side, but on the bond side, I think, we were fortunate to get in and go overweight at the right time. But yes, if we look at South Africa in isolation, we're starting to see improvement, but you also have to look at South Africa as a relative game, relative to the rest of the world. And it isn't rosy everywhere else. If you go look at, there's pockets of excellence in every economy in every country. And if you look at global markets, we've obviously had the Magnificent Seven performing exceptionally well. But if you look at politically, if you look at from an economic perspective, South Africa looks good. So we are still bullish South African assets and emerging market assets generally. I mean, barring India, which is quite stretched in terms of valuations, we're quite bullish emerging markets overall.
Yeah, and of course, South Africa has been probably a little bit oversold, probably a little bit too negative. We've had, for good reason, it's been 15 ridiculously ridiculous years. So there's some ground to make up. You got, when you've got 60% or 50% unemployment, you've got a lot of room for growth, which is different to what a lot of the established markets have got. They've got full employment. Where do they go to from here? In South Africa, we've got a lot of houses to build and a lot of mouths to feed.
And we've also got, room and capacity to cut interest rates, especially relative to our inflation rate. You compare that to where the rest of the world is sitting, specifically developed markets. They don't have much room to move relative to inflation. So we've got that. We've also got the fact that we're coming off a really low base. So, I said it earlier, we only have to get a few things right. And I think we've seen those positive offshoots from a stabilisation in Eskom and energy transmission. Yes, a lot of it was done through the private sector, essentially taking up a lot of capacity from solar. But you're now starting to see Transnet, not only an SOE, privatization coming through there. We've got strong commodity prices. If we can start getting our goods out the country, it all leads to positive, surpluses. And the GDP numbers that we're talking about as an emerging market, we've had some nice GDP prints, but really we're still only around hoping for just under 1% this year. It's not good enough. No. But for us to get to 2 or 3 is not that difficult. Yeah. And that is exciting.
Yeah, and before, now with the old finger wag, I have to speak to the people out there, because there's going to be people that will watch this and say, these guys are completely ridiculous. We've got this problem and that problem in the country. We acknowledge those problems. We acknowledge that South Africa is not Switzerland, right? But that has been priced in. The kind of devastation, economic underperformance has been priced in. We're talking about from the low base that we're on. When you say we can get to those higher growth numbers, it's because we've lagged on the growth that we've got the capacity to grow.
Yeah.
Right.
So. And you just have to look at the currency as the proxy for South Africa. I mean, we've obviously had a much better rand performance over the last year, and especially against the US dollar, which is a function of a bit of rand strength and a lot of US dollar weakness. But the bottom line is, if you look where the rand got to, there was so much negativity. I mean, we were almost pricing in failed state a lot of times. If you look at where our bond yields were and where the rand was, a lot of negativity is priced in. So yes, we've seen some improvement, but just go have a look back over 5 years and go see where the rand was, where it is now. We still got a lot of ground to make back. It's not like we are suddenly in this elevated valuation from a South African perspective. We still think South African assets are well priced.
Now, even though we've had some positive news, there are some laggards. Which are the laggards in our market?
Well, I mean, really last month there was a bit of industrial weakness that came through in the industrial sector. But actually, if you look at the market, and I think it's such an interesting dynamic, is if you actually look at, we've had this incredible run from resources, over 100% over the last year. I mean, it's phenomenal for a sector to perform that well. But if you actually go look at over the last 5 years, you see that property is still better performing than resources despite this big last year. Now, if you cast your mind back to coming out of COVID, property was almost uninvestable in South Africa. Now suddenly property has done so well over a 5-year period. So yes, there's some laggards, but generally speaking, we've had positive performances from all sectors. Last month, a bit of weakness coming through from Naspers and MTN. MTN very specific to Nigeria issues and potential CGT and fiscal issues out of Nigeria. China, and which obviously directly affects Tencent. Bottom line is that it's had a good run. Chinese markets rebounded really nicely. Every now and then you get a bit of news which causes a bit of fear, and there was a pullback, quite a big pullback. I mean, it's a big percentage in terms of a month, circa 8% pullback. But the bottom line is that you've had a really strong last year and last year performance out of China and all of these companies and sectors. So laggard last month, but generally speaking, our market's performing well.
And when a company like Naspers and Process come down, we've got to remember how high they've got. What a great performance. This is just a bit of profit taking.
100%. And again, we also need to be mindful of they're not as important in our index anymore, because you've had such an increase in your gold counters. So they were a very big part of our market, going back 6-7 years ago. If Tencent and Naspers was down 10% or 8% in a month, our market was going to be down. Now they're down that much and our market was still up. So which shows you how the dynamics of the market have changed with resources coming back into the fore in the South African construct again.
So now if we've, given the fact that we're outperforming global markets, and we've done so from over the past 5 years off that very low base, what is your outlook at Corion?
Yeah, I mean, it's so interesting when you look at it and you look at the at times the depths of desperation we had as South Africans and concerns, but we've had so many wins along the way, including GNU. And yes, there's a lot of criticism around it, but the bottom line is there seems to be the stabilisation. And to go look where you've had such strong move out of global markets, and over 5 years South Africa to be outperforming global markets just tells you that it is a great story. We sit on the southern tip of Africa, and there's a lot of people who've advocated to move all cash out of South Africa. Bottom line is, our view is that as South Africans, we've got South African expenses, South African liabilities, so we're always going to need exposure to South African market. And we're not sitting here with blinkers on saying we are always going to be overweight South Africa. But right now, our view still is, given that we've had the strong performance, we still think that there's value in our assets. South African banks are looking particularly well priced. So we've had a strong performance out of the resource sector, but financials are looking strong. South African bonds are still looking very good. We've had bond yields on our 10-year bond moving from 11.5%, all the way down to basically 8.5% over the last 18 months. But you're still getting 8.5% from our 10-year bond. Inflation is now, let's just say it's at the upper end of the revised band at 4%. That's a 4.5% return over and above inflation. That's attractive. It doesn't matter where you are in the world, a real return of 4.5%. That's what you expect from shares and equities. That's the type of risk premium you expect. So we still overweight SA bonds. We still overweight SA equities. We are still, from a house, underweight the big 7 tech. Doesn't mean as a house we don't have exposure, but there's such a big portion of global markets now that we underweight. We still like China and emerging markets generally. So as a house, we've had good returns, but we still think there's a bit more to come from SA.
Yeah, because as a house you manage retirement funds.
Correct.
You manage do a lot of wealth management. We've had the big move, thanks to some of the big moves of the gold stocks. How does in equity fund allocation, how do you keep pace?
And I think it's a very a tricky question at the moment, because there's always this active versus passive debate, and with the gold shares having moved as much as they have, they're becoming such a big part of the index. Basically, your call around gold is going to be very important relative to the index performance. In other words, how JSE is going to do. What we've done at Corion and our investment thesis is multi-strategy investing. So we try and diversify, and we're trying to get our returns from as many sources as possible. And even within the equity space, you can get different strategies that pay you at different times. So yes, over the last year, we slightly underperformed the index because we didn't have as much gold as the index. I mean, where gold is now, you almost need to be sitting with 18% exposure to gold, where that used to be 2% as part of our index. It's very difficult for us to, especially in retirement fund portfolios, to believe that our clients should have 18% exposure to gold as part of their equity exposure. So we are underweight gold. But over the last 5 years, our equity fund has still outperformed the index, even with this resource move, because we've got different strategies within our equity allocation. And that diversification gives you the ability to earn, for your strategies to perform at different times and not be dependent on only the gold sector now for the next year, or back in the day when it was what Tencent or Naspers was going to be doing. Our job is to try and not be solely dependent, or actually try and be dependent on as many factors as possible, as opposed to just one index or one sector.
Yeah, and the gold price notoriously difficult to predict.
Volatile.
And it doesn't necessarily follow a clear pattern, and you can end up something shooting the price through the roof and vice versa. That's always been the challenge for South African fund managers. Let's move our attention over to bonds and bond yields, because they've had a hell of a run from 11.5% all the way down to where they are now, 8.5%. You know, we would have, if you had said that to people a year ago or whenever, they would have called you mad. Is it time to take some money off the table when it comes to bonds, or given our low inflation, has it still got some room to go?
Look, it's been a very prominent debate in our investment team for the last couple of weeks and even months about, we've had such a strong bond price move. So as a house, we've trimmed bonds, but we still overweight bonds. Again, going back to, if you can get inflation plus 4.5%, you are sitting in a very good position. So to be getting that from essentially your lower risk asset class being bonds, because equities is generally perceived as higher risk, and therefore if you're taking on more risk in shares, you should get more reward. But if you're taking on bond returns and getting that type of real return, we think it's very attractive. So I think our bonds, what we need to, and going back to the negativity and how negative the outlook was for South Africa and South African assets. I mean, where bonds were, you're essentially pricing in failed state. You're pricing in really, really bad outcomes from a political perspective. It was dire. We're now in a position where we're saying, from a political perspective, we think there's been a lot of stabilization. We think country risk is largely out of, there's always risk. But from where we are relative to a couple of years ago to where we are now, we think risk has been mitigated. And if you look at our risk relative to other emerging markets, we're trading on a similar country risk to what Brazil is. So if your country risk has been mitigated, then it actually boils down to inflation. Largely, what is the risk in the country's inflation? Rand's quite firm. Oil prices seem to be pretty stable. We've got strong terms of trade at the moment, strong commodity prices. So we think that bonds are still very attractive, and we are maintaining an overweight SA bond position.
And let's not forget our strong capital market structure, especially around banking. Good regulations, sometimes almost too much regulation, which is never really a thing, but it means that our banks are fairly solid. There's not a lot of systemic risk in the system, is there?
So our capital markets have always been, at the forefront of world markets and even against developed. So from our equity markets to our bond markets, very efficient, highly regulated. Our banks are incredibly well capitalized. So yes, there is a lot of underpin around where we are fiscally. There's an underpin around where we are from asset class pricing, that there's still value to be extracted. We've had really good returns over the last 5 years, but remember, it was also coming out of COVID and into the last 5 years returns. But we, on a relative basis, if you look at our share price multiples, how you value a company, your price to earnings, how many times your share price is valued relative earnings in a year, we're still well priced relative to global peers and relative to emerging market peers. We're looking good, and strong bond, and compelling bond valuations. So assets, South African assets generally, we're quite bullish.
I just want to pick up on something you mentioned about the good capitalization of our banks, which is a feature of the South African economy. That possibly gives them a little bit of room to loosen the purse strings just a little, isn't it? They could become a little bit more generous in looking for other areas of investment. In other words, that's code for they may become a little bit easier to lend money from.
Yeah, and again, I think it goes back to that confidence element. If we start getting more foreign direct investment, we start getting local companies investing more, banks start getting, being able to, credit extension increases, a little bit more relaxation around lending, off the grey list. Again, we didn't touch on that earlier. All of these positive tailwinds. Again, we're not sitting here burying our head in the sand and saying there's no risk. Our job is to look out for risks.
Mm.
We're continually monitoring risks. You can never mitigate, but what you can do is diversify and, be exposed to different strategies, different asset classes, different geographies. But right now, there's a lot of tailwinds and underpin to SA.
Now, Gareth, South Africa has quite rightly earned a reputation, and South Africans, all of us, have quite rightly got a reputation as being quite poor savers, especially if one looks at, countries in the East where they've got a savings culture.
Yeah.
South Africa really hasn't had a great savings culture. With these strong markets, do you see that culture changing? Do you see South Africa getting a better culture of saving than what we have? Saving and investment, I suppose one should call it.
I think it is one of the biggest issues we've got in the country, and it is understood. If you've got high unemployment, low disposable income, it is very difficult to save. It's a function of for a lot of people putting food on the table. Mm. So the sad part about the strong market move is that if there was a stronger savings culture and ability to have saved more, these are the types of markets that you need to have saved for, because it's very difficult to predict when you're going to get a 35% performance from, which is, the South African, the JSE all share performance over the last year. It's 35%. Mm. It's a remarkable number. What we can't do is predict when that's going to happen. But what we can tell you is over the next 10 to 20 years, you're going to have strong markets. Yes, there's going to be weak markets over a period of time, but generally speaking, equity markets go up. You're rewarded. And it is impossible to time. There are a handful of people in the world can say this is the year. Mm. So therefore, savings needs to be a conscious effort where every month, it doesn't matter if it's 50 Rand, put it away. Because when markets perform, this is when you are rewarded. So sadly, I don't think that this is going to be a broad benefit, because the savings base in South Africa is extremely narrow. And it's something that we need to do as an industry. It's what we need to do as corporate South Africa, is to drive savings, make sure that we got retirement funds in place for employees. Again, I'm not sitting here, in utopia and saying, oh, everyone should save and there's just cash falling. I understand the plight. I understand that, but it needs to be enforced. Yeah. It needs to be a conscious decision to be made to save, because this is how you can be rewarded. And that's an education element.
Yeah. And obviously one of the first things that before you start saving is to get rid of a big portion of debt, especially that short-term debt that is so punishing.
Yeah. And I think of one of the sad parts of two-pot, where I think actually the concept behind two-pot works, giving people access to savings, and then enforcing a retirement. I think that is great. I think a lot of the sad part of when that pot became available, a lot of it went to paying down debt, as opposed to actually, helping people. It was just almost servicing debt. And so it is a problem. I have no, but we do need to get that short-term debt down, but we do need to get savings. Most people's primary residence is their biggest investment vehicle. So people have got bonds. You want to try and reduce that. But it's a balance between managing your bond and also saving for retirement, because it is, and with life expectancy increasing, it's becoming more of a concern. So people do need to start, and especially start early, because that's when you get the compounding benefit through time. You get these types of market performances through a longer, you had more time in your savings career or a saving cycle to experience a market like this. So yeah, it is, we need to be saving earlier and we need to be saving more. There is no doubt.
And for many people that have had 15 years of hell, it's like getting back on the horse. It's been a while since there's been a saving culture for many people, because through maladministration and a few other things, we've had 15 years of hell where you're just trying to survive. Gareth, probably to me the biggest thing that has happened, it has been, and we've mentioned it and had quite a few commentaries from Corion and even on the political side, was just to go back to it and the importance of it all. The medium-term budget statement compared to the budget debacle earlier in the year.
Yeah.
It shows that people are speaking off the same hymn sheet. It's almost like a penny dropped for the government that's for 15 years been out of control, that, hang on a second, there's a better way to run the country, and that is significant, isn't it?
It's massively significant. And again, yeah, South Africans, you can sit back and say, oh, I wish more people had been prosecuted. I wish there would, but there seems to be a lot more emphasis on control of expenditure, on going after a lot of the corruption. Yes, it is still endemic and there's a lot of work to be done. But I think, there's two elements to a budget. There's revenue and expenses, and you need to control both elements. It doesn't matter how good your revenue is if you've got a runaway train on the expense side, and if you've got, total graft going on across multiple entities. I think it's been arrested to a large extent. A lot more work needs to be done. But you're now seeing, from being unable to deliver a budget to where we are now, and again, get this GDP to 1.5%, 2%. South Africa is in a good position.
Well, ladies and gentlemen, the message that comes out is that we do need to pay more attention to our own personal well-being, savings, investments. If we do start seeing some significant economic growth, if you start seeing a difference in your pay packet, some of it should go towards your future, your retirement, etc. Then perhaps you may want to pick up the phone and speak to people like Corion Capital. Go out and have a look. There are many other wealth managers, but I can recommend Corion. But hey, we have to take control of our own financial future. The government, we cannot depend on them to do it for us. Gareth, thank you for sharing your insights with us today.
Thanks for having me, Mike.
And to everybody that watched this, thank you. Subscribe to the channel. We'll see you again on the State of the Nation Business. Thank you for joining us today.